On my left, you're requested to take your seat, please. I welcome you all after the small tea break. And our today's second session is on strengthening of regulatory framework for algorithm high-frequency trading in technology-driven era. Before we start the discussion, I would like to introduce the dignitaries on the dais. Shri Hector Collin, COO, Asia Pacific ex-China, Citadel Securities, Hong Kong. Shri Nirav Parekh, Global Head, Electronic Trading Listed Derivatives, Citigroup Global Market Asia Limited, Singapore. Shri Tushar Mahajan, Head of Listed F&O, India, Nomura Securities. And this session is moderated by Shri Harjeet Singh, Consultant, DEA-NIFM Research Program, National Institute of Financial Management. Thank you very much. Now the floor is for the panel. Thank you. Harjeet.
Good afternoon, everyone. Respected dignitaries from the Ministry, the exchanges, SEBI, as well as participants from the financial institutions and brokers. Thanks to the panel speakers here for sparing their time and coming here and being part of this important forum to discuss some of the policy recommendations going forward. Without wasting too much of time, I think the whole background context has been said in terms of what are algorithms and, what is a path that we have already covered, right? So a lot of it has been spoken in terms of how far have we gone, how far have we come, but the question remains with regards to what needs to be done in the future. All of us agree that as far as algorithmic trading is concerned, we have a fairly conservative regulatory framework, which kind of protects against some of the things which have happened in the past in various markets. Having said that, in spite of a conservative regulatory framework, we have still seen issues such as flash crashes, such as fat fingers, such as software glitches which have happened in markets. And we would like to definitely address these issues. I would like to start by understanding the market microstructure, because before we get to solutions, let's understand how the Indian markets are. What is the market microstructure of India versus developed markets, so that we understand what are the various issues which can crop up, right? So in terms of our Indian markets, is the market microstructure more susceptible to flash crashes, fat fingers? What is it that can be dealt with? What is it that we are sitting in India? And how can we devise a policy framework against these issues? So it's important to start with the market microstructure, the understanding of what the markets are. So I would like to pose this question to Hector.
Thank you. Before we get to that, actually, I'd like to address that wonderful man's concern about having a framework. I'm sorry, what was your name? Venkatesh. Okay, Venkatesh. And I'm going to tie it in to this wonderful woman's suggestion for frequent batches. I'm sorry, what was your name? Rosemary. Rosemary. Beautiful name. I'll start that basically by telling a story. Actually, it happened to me yesterday. I share your frustration with a lack of framework, a proper framework in which to sort of make policy decisions. And I had some free time yesterday, and I went to the National Museum of India. And other than the whole security and boys on one side, girls on the other, and the aircon not working, the first thing I noticed was that the cost to enter for foreigners is significantly higher than for nationals. Okay, so you can understand my frustration with that. And especially given the cost of my personal time to plan the trip, to pay for the hotel, pay the airfare, come visit this wonderful country and go to a place that I thought I would be able to access knowledge and learn more from, and being charged a significantly higher amount to partake in that. So I started thinking, who in their right mind in a room would be like, you know, it'd be great if we charged tourists a lot of money to come in here and learn about our country. So I share your frustration when it comes to setting a proper framework in which to make policy and regulatory decisions in. And to your point about frequent batch auctions is what we've noticed, that I think I'm the only foreigner or one of the only foreigners in the room. So when I say we, I mean foreigners. What we've noticed works is when you introduce something to solve a specific problem, not just because it sounds like the right thing to do. And there were multiple times speed bumps were mentioned, and I would say study what happened on the TXX Alpha Exchange in Canada when they introduced speed bumps to understand what the backlash of consequences that were unintended could happen. Similar thing with frequent auction in Taiwan, which introduced many different inefficiencies when it comes to pricing derivatives based off of an equity market, where the derivatives are continuous and the equity market is batch. Additionally, the competitors to the TWSC are still continuous, which means there's an arbitrage rent that you're paying when you say, put my order in the market, keep it there for a certain amount of time for everyone to see that you're going to pay. Again, there are unintended consequences that can come from that. So I think so on that note, I think I'm going to pass it over to Nirav to talk about the microstructures.
Yeah, I would just like to rephrase my question. Specifically, what I want is to understand from you guys is that your experience as an FIA, how do you think is the market microstructure in India different from the developed world, and what kind of issues do you see coming through with this kind of microstructure?
Okay, maybe I'll answer that one very directly. We see a couple things missing as an FII. One is India does not have a official acknowledgement of a market maker category. We think that most markets that do actually are more transparent, they're more open, and they're more efficient. And let me explain why. Because as a market maker that's officially recognized, we have to have direct interaction with the exchange and with the regulators. And we have to flag all of our orders in order that the exchange and the regulator can monitor the requirements that they put on us as market makers. We become very easy to regulate, and we become very easy in the market to identify. That adds to openness, it adds to transparency. The direct interaction with the exchange and regulators also mean that we are policed very efficiently and very stringently so that we can provide the liquidity that many other participants say they provide, but we provide it at specific prices at all times, even during market duress, not just because it's convenient.
To share your thoughts.
Yeah, so I think on your first point about the microstructure, there are a fair bit of dices and slices which one can do when you look at the market structure. You could look at the market structure with respect to products, so equities and derivatives, and we've seen how the derivatives market has kind of exploded in the last 5 to 7 years, largely driven by technology, largely driven by algorithmic trading, so that ratio has changed from maybe 1:4 to almost 1:15 in the last 2 to 3 years. If you divide the microstructure by participants, you have a fairly large contribution coming in from prop shops of brokers or people who are classified as prop traders versus individual retail participants versus institutions. So incrementally, I think in our market, the role of institutions has increased, but still the largest contributors to the market volumes continue to be prop traders. If you look through channels, today we are at a situation where almost 40% of your volumes are happening via the electronic or the non-manual intervention route, which is driven, by latest statistics, about 15% on co-location and 23% from algo trading. So that's another way to kind of look at the microstructure in the market. And when you compare that to what happens globally, I think I would just supplement with Hector's point that India does not have an official recognition of market makers. We believe that a lot of the prop traders or a lot of the domestic brokers in their prop trading capacity provide that role, but not having an official acknowledgement of market maker as a category means that you are not assured of liquidity at all time. With prop traders being guised as providing liquidity, but not under the regulatory obligation to do so, you would see a lot of times that pockets of liquidity vanish because there is no regulatory obligation to provide that liquidity.
Thank you. And first of all, thank you for having me here, and it's a pleasure to be talking to you all. I've worked for some part in India, and then for most parts of my career outside India. And what I'm hoping is that I can share with you some of the experiences, putting my Indian perspective on it. Right. So if you like it, I would appreciate that. If you don't like it, that's fine. That's just my view. Even closer? Okay, better. All right. So I think, first of all, what we are discussing here today is an important discussion. And this is a discussion that's going on globally. It's been going on for a while. It continues. Some things have been kind of agreed, or at least a consensus view has been formed. Other things get opened up again for discussion and continue getting discussed, right? So I think in the context of the question that was asked, do we have a specific problem that we are trying to solve? I don't think so, as in it's not an urgent problem that we need to fix today. But before us, we've got a trading pattern and a style that's evolving, increasing in certain aspects. And the question is, do we have a framework in place today that's adequate? And if not, what is it we want to change? Or what is it we're looking at and want to change, right? That's at least the context with which I'm coming into this discussion. I think we also find that there's a lot of terms being thrown around, some of which very well understood by some people, and other terms not very well understood by other people. And when you mix up all those terms, it becomes hard to have a rational discussion because people are coming into that discussion with very different perspectives. So I think it would help if some of those perspectives could be aligned at the discussion today. And we have on the panel, at least some variation in terms of perspectives, even from this side of the table. You have somebody who is looking at it from a buy side, market maker, participation. We've got intermediaries. We heard the exchanges. All have a view to share in this space. And I think they're valid views, and we need to bring them together in a meaningful regulatory response. I will then just go on to add this. I think India has been thinking on these points quite well and quite deeply. And there are good reasons why India does what India does in terms of how our markets are shaped, how our systems work. And there are good reasons why it has chosen to adopt some things and it has chosen not to adopt some things. I think this is not a kind of a point in time thing. You've got to constantly keep revisiting and reviewing it as your circumstances change. We need to look at what needs to change within our regulatory framework. But it's not like that has not happened. And in many cases, I would almost argue that India has been ahead in its thinking in terms of what it should do or would like to do. I think where probably, if at all, we want to think a little bit more is how effectively we implement it, right? My observation, and it's my observation, so please take it just for that. My observation has been that we sometimes get focused too much on controlling as opposed to achieving, right? So we try to control behaviors as opposed to kind of look at it from what we want to achieve. And I think if you were to just kind of remain focused on what we want to achieve, control inevitably will be required to stop those few people who are not aligned with you on the journey. But having control as your primary tool probably is not going to get you on the journey to begin with. So we'll talk a little bit more about this, but we want to remain focused on what we want to achieve. And in context, just to put that in context of what Hector mentioned, he comes at it from a perspective of what he, as a contributor to this economy, wants to achieve, which is wants to provide liquidity. His organization specializes in providing liquidity as a market maker, has a lot of experience, wants to bring that to bear on India, and they see certain challenges. We as intermediaries, again, we operate in 60 markets globally. India is a very important market for us, and we would like to bring some of those experiences, some of the tools that we have into the Indian market. Some will work, some will not work, and that's fine, and that's exactly what we got to think through. Right, so I just wanted to set my context on that. In terms of specifically answering your question on microstructure, I think in many ways India is a very advanced microstructure from the market. We have the right trading platforms in terms of the way they are, the way they implement it. We are already in price time priority. There's a discussion going on whether we should revisit that. I would say by all means let's talk about it, but let's not be hasty to jump into it because a lot of other people have been talking and have tried it, and I think we should learn from their experiences. Where we are today is where a majority of the exchanges are anyway globally. In terms of some of the risk controls that we have here, I think again, in terms of its intent, India is actually quite ahead in its thinking. The requirement to have your algos tested before you put it in place, the requirement to simulate a market on a weekend with a view to create an ecosystem that you can actually test it in is great intent. Now you can argue whether in practice that is being achieved, but that's where we kind of have to discuss a bit more about how that implementation is playing out. And surprisingly, I was in London a couple of weeks ago, and Brexit is a big topic that is in discussion right now. And I was sitting silently. I was not one of the key contributors. I was more in the audience listening. But it was surprising to see how many comments were being made, which, given my background in India, were resonating, right? We need to know every single investor in the market. They need to get registered and must have an ID. Before we give them access, we need to have their algos tested. We need to have things monitored. Everything must be UAT tested, to which somebody raised a point, but we don't have enough UAT environment that simulates production. How do we achieve it? To which somebody, again, half thinking, responded, well, we have Saturday and Sunday where we're not doing anything with our production system. Why don't we use that to test? And I came back thinking in a circle, that's what exactly we've been doing in India for a while, which we call the weekend mock testing, right? So I think there are good reasons why we have tried to do what we've tried to do with mixed success. As I said, I don't think there's too much wrong, but I think we need to have a talk and try and see where the market's going and hence where our regulatory policy needs to go along with it. Back to you, Harjit. Thank you.
Sorry, just so you don't think we all agree up here, I actually disagree with quite a bit that Rob says. One is, there isn't an easy remote access regime for foreigners in India. And what I mean by that is the whole concept of intraday trading, which is not accessible as a foreign institution. The stock loan guidelines that India has in place are extremely, extremely onerous. There's no universal risk layer in the sense that, if I'm going to do the 13 risks check, I have to implement that myself, and I can implement it any way I want. If this existed on the exchange side, then everybody would be doing it the same way. Without, rules and regulations that address some of these things, you're not going to have what I would consider a fair market. Things like margin efficiency, the minimum margin requirement, which affects everybody, not just foreign institutions, for example. My span margin may be saying, I only have a very close to zero margin requirement, yet I have to post 3% minimum. vastly different than, I think, most of the other competitors. And when I say competitors, I mean other exchanges, right? Because as a foreign institution, we don't look at BSE versus NSE. That's a very local debate here. We look at India versus Singapore versus Japan versus Taiwan versus Australia, right? So when we look at trading our risk and managing our risk, we do it in the place where we can do it the most economically. Not necessarily, you know, I bought stock in India, so I have to sell stock in India or short a future or build, you know, do some sort of single stock future or option on that particular derivative. I look at, is it easier for me to manage that risk by having a basket of stocks in Korea? So I don't agree that you have addressed the issues that most of the developed world has, right?
No, just that nobody mistakes that we disagree on everything. I do agree with a few of the points that he's made, right? Am I on? Good. I don't think, I think Ashish said it well when he sat in this seat or the next seat, which is said, we've come a long way, we've a long way to go, right? And I think he was on the mark out there. And are there things that are in the Indian market that could be changed? I would agree. Are they for the better? In general, I would agree with that as well. I think it's a sign of an economy that is opening up, and it's a journey. And I think as the time has come where our markets mature to a point where we feel comfortable having foreign participants in, you know, directly involved in the market because it helps, increases that pool of liquidity. I think we need to bring in the relevant things that then allow for that offshore access, foreign participation to grow along with it, right? So to one of your points that, you know, offshore access is cumbersome, absolutely. As intermediaries, we feel the pain as well because for most markets, we operate global desks. We operate desks that are based in our hub locations and clients call into our hub locations and we can trade anywhere else we want in the world. It comes to India and it's a very different access mechanism, right? Forget electronic, just in the conventional sense as well, it's a very different access mechanism. There are ways to solve for it, but they are unconventional and sometimes it's just easier to operate India as a standalone market, which in some ways is good and in other ways is bad, right? So to Hector's point, I don't disagree with that. I think to what Hector raised, two other points, though, I think are very valid points. And I think something that definitely our policymakers want to give it, they've already been giving it this thought, but I think from a global perspective on how we see other exchanges and what we see has worked well, I would definitely say we need to give it a hard thought in India. And one of that he mentioned was exchange access, right? I mean, as we look to implement controls, the question that arises is, where is the controls best implemented? Should we leave it in the hands of the intermediaries and the investors who have, you know, very differentiated means of implementing and may not have the controls that we need for consistency, versus should we force the venues to implement most of the risk controls that's required to prevent, you know, anything from a systemic point of view happening in the market? And I think we've seen time and over again in almost all global exchanges that the answer comes to is that some of these risk checks are best implemented at the venues. They can be supplemented by additional risk checks beyond the venues, but I think venues is where the risk checks are. And what it creates a level playing field. It takes away regulatory arbitrage out of the discussion, which, you know, several years ago and continues to in some markets even today, you see a lot of regulatory arbitrage because of the ambiguity in how regulation is interpreted. People will then use the path of least resistance as is natural, and then you will find that inconsistent implementations are done. A venue enforcing it consistently, commonly, is what creates the fair access that, you know, we heard on the previous panel, fair, equitable, and common access. So no, I mean, Hector, I agree with you with that. This is, I think, as India opens up and we want to invite foreign participants, we need to understand some of these global practices and where it makes sense, adopt those in the context of Indian regulation.
And I think just to add to his point, you know, to saying that what we were thinking is probably what, you know, the Brexit example of talking about stuff which India is kind of already doing, this weekend testing and all of that. We spoke about algos being tested much before we allowed algos to kind of come in to start trading. So I remember, way back in 2008 or 9 when the first set of open direct market access talks were being done. That's when India spoke about the fact that they wanted to have a regulatory mechanism where you had to open up your algos to the venues to get that tested. That wasn't the case globally anywhere, and there was a lot of hue and cry, but we modified that to saying that what we want to test is for risk checks and not necessarily IP in respect to algos. And globally, you see the discussion over the last 3-4 years, which is moving to a lot of the developed markets who are now saying that all algos which need to go in a live environment need to be tested at the venues. So I think that's the kind of regulatory oversight which Nirav probably mentioned, which a lot of exchanges are now talking, but India spoke about it much earlier. And not to take away the point about the ease or the lack of ease of access.
Thanks for your comments. Just digging slightly deeper into the very interesting market maker category solution, which Hector pointed out, wherein you flag orders, right, which helps differentiate various market participants. Now, I want to ask you a direct question. Are there any precedents for the same, number one? And second, is there any differentiated policy benefit coming out of this? Because ultimately, if you're trying to differentiate market participants by flagging orders, you also got to arrive at a stage where you differentiate the policies for various market participants. So has it led in any kind of market to a differentiated policy regime, which I think is very critical when you're dealing with a market with such a varied set of market participants?
So to answer your question is yes, there's plenty of literature. If you want to Google it, that's fine. I will also tell you that the trend is towards identifying orders. We all know Japan is publicly announcing, I think starting in a few months' time, all orders that were not entered into a system must be flagged as such. MiFID is introducing the concept of not only flagging orders, but putting trader names specifically on there, regardless of whether they're some technologically aided entered or whether they're manually entered. So I think going to a scheme where you identify who you are and potentially why you're doing this order, right? Because that's also a key component. In Hong Kong, for example, you have to tell them why you're doing this order. And if it's a hedge order, then guess what? You are rewarded for your transparency. So as a market maker, we make a huge investment in technology infrastructure. I mean, that's well publicized. Everybody knows that, right? And the debates rage all across the spectrum. But the fact that we offer to be open and transparent and fair and present at all times to absorb liquidity no matter the crisis, without a view to the fundamentals of a stock. So we don't do any kind of research or analysis. Is the stock going to be a takeover? Is the stock going bankrupt? We don't know. But we're there to provide the liquidity so that people can actually trade in this and it remains as orderly as possible. But we expect to be rewarded for that, right? If we just sit here and concentrate on saying, you do something wrong, we're going to penalize you, and just worry about the penalties when somebody does something wrong, and we don't say, hey, wait a minute, there are some guys out there, there's a specific category that is willing to help us achieve what we want to achieve, but we're not going to reward them for doing that, then it's not fair. It's, there's two sides to both, and the coin, the sort of the scale needs to be balanced.
I think a very humble submission is that from a regulatory perspective, we've a lot of times focused on catching the wrongdoings and penalizing for those errors, whereas historically in a lot of markets, the beneficiary of you are rewarded for your presence, or you're rewarded for just being there in the market when a lot of people decided to venture out. And that is a thought process which, as regulators, we need to kind of establish. And also, maybe the first step to do that is to identify people who are willing to provide that liquidity at times and expect to be rewarded in that case, similar to what Hector was saying.
I think, let's face it, there are always market makers in any market other than the most trivial of markets. And the question is, do you formally recognize and accept the contribution they make to the market, or do you let it happen implicitly in the gray space? And I think most of the exchanges kind of come to the conclusion that it's better to know who are those liquidity providers and then partner with them, incentivizing them to provide that liquidity, putting obligations so that they continue to provide liquidity, not just opportunistically but consistently, and working as partners. In fact, whenever a new exchange launches, and we see a lot of new exchanges launch all over the world, amongst the many questions that we ask, one of the questions that we ask is, do you have a market maker panel? Who's on the panel? What sort of liquidity do you expect? How are you going to incentivize them, right? Because for us, seeing the strength of the market maker panel is one of the indicators of our confidence that this market has a room to grow. Because it's a critical part of the ecosystem, and sometimes in a new growing market, it's a critical part of the ecosystem because the ecosystem is still forming. And unless you don't have market makers that are making two-way markets, it becomes hard for that ecosystem to nourish and grow. At some point, you can argue that the role of the market maker is somewhat diminished. Although again, in mature markets, a market maker probably has an even more important role to play. Especially then the obligations come into play that a market maker is obliged to make two-way continuous quotes, notwithstanding the market condition. Right? And so you start putting obligations. Earlier it's an incentive, but subsequently becomes an obligation, and you've got to incentivize them for that. They are taking risks in order to provide two-way continuous market, and if you do not incentivize them, either they will not make those markets or they'll make the market so wide that it's practically useless. Right? So, and Hector, I'm sure, will talk more about the risks a market maker takes. And again, as a regulator, we need to be cognizant of those risks that are being taken by the market makers and put a policy framework that allows for those market makers to, within reason, manage that risk. Again, if we don't do that, it's only going to hurt our market because then you're going to find that market makers won't do the job, bid-ask spreads will increase, cost of transaction will increase, cost of capital will increase. So, yeah, Harjit, I definitely see a role of market makers in these markets.
Going on to the next topic of discussion, which is directly on SEBI's discussion paper. Now, it's been, I think, more than a year since the discussion paper is out. It seems all of us are waiting for some calamity to happen so that we revert back to the paper and some kind of a structure goes into place. So directly addressing those points in the discussion paper. Now, there were various measures which have been introduced in the discussion paper, starting from a minimum resting time for orders to be in the order book, to random speed bumps on the algo trading highway, to randomization of orders in a specific time window, to provision of two separate queues, one for colo, the other for non-colo, and also frequent batch auction in a certain time window. So which do you think, according to you, will Indian markets really benefit? Number one. Second, are these measures which have been suggested here more regressive rather than constructive? Number two, if these are constructive, number three, if these are constructive, which, according to you, are the markets which have implemented these and where there's documented evidence of these measures working? What it looks like is that we've had tons of suggestions going worldwide, which regulators have looked at and have thrown that away. And we are still in a process of trying to understand what are the implications of each of these measures. So just wanted to get your opinion in terms of what will work in India, because India is very different in terms of the market structure, and if yes, to what extent? Starting with Hector.
I would go back to say, and implore anyone who's involved in the decision-making process for the policy and regulations that you guys are considering to remember that putting policy in place needs to solve a specific problem. So if you're going to put a speed bump, make sure you know what problem you're solving. If you're going to have minimum resting time, make sure you know what problem you're solving. There are numerous unintended consequences that we've seen, and they generally end in a backlash, and undoing that damage is very, very costly. Before doing any of this, I will go back to where we started the conversation, which is, at first you need to really spend time on your ecosystem. You need to have a healthy ecosystem which encompasses all the good things that you've noticed about your competitors, right, around the world. Now, again, this isn't a national problem. This is a what's worked everywhere else. And as I mentioned earlier, there are some very important things, some very fundamental things that are missing before you can unequivocally say, we have a framework or an ecosystem for investing, but it doesn't work. I would argue that you're missing some key components before you make that decision. So don't just put something in place for the sake of putting something in place, but make sure it's a problem, a specific problem you're trying to solve.
Just taking up from there, I think a lot of the press on algo trading, high frequency trading globally started with the US flash crash in 2010, when the S&P went down some 10% in some 15 minutes, and everyone said it's only the it's only the high frequency traders who've caused this kind of crash. However, when both CFTC and SEC went to investigate that, it was found that yes, there were high frequency trading firms which were part of the flash crash, but they were not the ones who caused. The market reaction of that was pretty similar to the earlier market crashes, let's say maybe of 1987, which is fairly well spoken about, where the first response of the intermediaries or the market makers or the HFT firms was to try and stabilize the market by taking opposite side of the positions. But what had caused the crash was so overwhelming that ultimately these firms exaggerated the cause of that move because they had to finally liquidate that position in trying to stabilize it. This is exactly what had happened in 87 as well, where the intermediaries first came in to take opposite positions and then did it. So the fact remains that from a regulatory perspective, what we are solving for is pretty much the same set of problems which have existed in the past. And trying to create artificial hiccups without knowing exactly what we are trying to solve is probably not going to exactly get us to a point where the regulation is at a fairly ideal level. For example, when we speak about the fact that the frequent batch auctions could be a response to limit high-frequency trading, get latency-sensitive people out of the market, etc. The fact remains that if we start doing that, the high-frequency traders are anyways going to go out of the market. So you're not really solving for a problem, but you're creating a new problem by getting liquidity out of the market. So we need to know each of those things. And literature also has proven that globally, exchanges, whoever have toyed with artificial bumps along the information highway, have all retreated before finally implementing it on their exchanges. For frequent batch options, Taiwan is cited as a fairly good example, saying that it's worked very well in Taiwan. But the fact remains that Taiwan has been reducing the time of the auctions from 20 seconds to 15 to 5 seconds, and are effectively deciding to go to a continuous trading model versus a batch auction. So do we want to cite that as an example to say that this probably solves the problem? I think it's time for us to take a deeper rethink into it.
I think I resonate. I think most of what I was thinking has been said out here. I think Hector nailed it when he said, let's be sure we understand what we want to achieve out of this, right? All of these things that have been proposed to me sound like trying to control a particular behavior as opposed to focus on what we're trying to achieve. And I think Mr. Limay said it in his earlier presentation, and whatever we put in place needs to be fair and equitable in its entirety, right? Not just something that we put in place that then stops one particular behavior without taking the long-term consideration of whether that is the best outcome for our market and for our entire ecosystem. And like he said, Tushar said, we've seen this time and time again, right? I remember a very similar discussion. I'm sure a lot of people sitting in this room probably were also part of that discussion process when pit trading moved to terminals. And there was a lot of concern that the people on terminals would have unfair advantage to the people who are trading on the pit and vice versa. And that debate went on. I mean, imagine if 20 years down the line, if you thought that you had made policy decisions that would have not allowed terminals and trading to move on to electronic terminals, we would be having a very different discussion today as opposed to talking about algorithmic and high-frequency trading, right? So I think there will be things that we'll need to think through. There will be aspects of the ecosystem that we'll need to put things in place to control. But I think most importantly, we need to remain focused on what we're trying to achieve out here. Thank you.
So once again, I would like to reiterate my question. See, because all of us are trying to seek clarification.
Before you reiterate, so I think the most important one you want to find out is which ones would India benefit from the most out of the 6 or 7 that were identified in the paper, and where in the world has any one of those worked, right? I mean, which nobody here answered. I'm fully aware of that. But I want to remind everyone, that in order for any of these to work, I don't care which one you pick, if you don't have the right framework, it's not going to happen, and you're not going to get the result you want. And my point, just mine, is India right now doesn't have the complete framework in which to say, this is the one that's going to work. Okay? If you say minimum resting orders, for example, well, guess what? Everyone, because they know they're going to have to be there longer, they're just going to go wider. And guess what you've done now? Bid and ask spreads just blew out. And guess what? It just became more expensive. Is that what you really want? Right? So, without the proper framework, for example, introducing an official market maker who's required to be in there, right? It's not going to work. You're not going to get the result you want. And we've seen it around the world, the unintended consequences. And we've also seen the backlash they generate. And now in Europe, you have this massive MiFID initiative, which is so onerous. People are considering just jumping out, just essentially abandoning it. It is really onerous, and the cost of complying with it is astronomical. So before you ask me again which ones I think is going to work and which one is going to benefit from, what I'm saying is, unless there's a specific problem, none of them are going to work. And until you have a complete framework, which was pointed out during the first panel that perhaps you don't have, it's not going to work even more.
I'll just add to that, Harjit. Sometimes a no answer is an answer unto itself, right? So if you're reading us between the lines, you probably would have heard that answer loud and clear. I'll just go on to add. I mean, SEBI's paper was meant, I think in the best of intent, was meant to address an unspoken question, or at least I didn't read it directly, which was, what are the issues with latency, and do we need to slow things down? Right? I mean, is it creating an unlevel playing field? Is it giving somebody inherent advantage? What are the intrinsic issues that it's trying to solve for? And is it really something we need to solve for? I mean, talking in several different ways. We spoke about putting things in place that slows down the space of trading. Whether you call it frequent batch auctions, whether you call it minimum resting time, whether you call it, there are several different aspects. Now, they were all done for good reasons, but I think it needs to ask the more basic question, is latency truly the problem? And like anything else, it's not a simple yes/no answer, right? And that's why you need to get into the details to understand which aspects of latency are hurting us and which aspects of latency are actually what we're looking for, and nurture the ones that we're looking for and try and put some guide rails around the things that are hurting us, right? I think vilifying that entire aspect, I have a lot of discussions with a lot of people, and I find that sometimes when I talk to people, people look at me in awe because they don't understand what I'm talking, and sometimes they look at me like he is the villain because, again, they don't understand what I'm talking, right? When I say what I'm talking, I run the electronic execution business, and high frequency and co-location and latency are words that come up very often in what I talk. And a lot of people kind of, I get one of the two responses, and I think both responses are not the right responses, right? So to Harjeet's request of getting more specific, I'll just take a few minutes to actually outline what I think are some of the ways in which we should look at risk. And I'm not going to kind of list down the risks because in each market that needs to be looked at in context of your local dynamics and your market ecosystem. But when we look at risk, in the specific space of co-location, algo trading, high frequency, I tend to break that risk down into two broad categories, right? I break the risk down into conduct risk and systematic risk, right? So what do we mean by each? Conduct risk is the risk of somebody doing something that they should not be doing, right? That's conduct risk. And conduct risk itself comes in two forms. Somebody does something that they should not be doing because they did not know they should not be doing it, or they did it regardless, right? So they knew exactly what the rules were, but they chose to do something different, both of which are conduct risk. And then your second category of broadly, and again, these are very broad definitions, but I'm hoping that, I'm sharing the framework with which I do some of this analysis. If it helps, that's great. The second is systematic risk. And again, systematic risk along the lines of conduct risk is very similar. The risk of a system doing something it should not be doing, right? Now that could happen because a system was not designed to do everything it should. So we had a problem in the people who designed it, and hence it had consequences, intended or unintended. And then sometimes a system doing something despite you having built those controls in it because those controls didn't work the way you expected them to work, right? Machines are not manipulative by nature. If you have a problem with an algo that turns out to be manipulative, it's a conduct risk. You go back to the person who designed the algo because you have a conduct risk issue. Your regulatory response or policy should be from a conduct perspective if the algo is manipulative. But if the algo simply does not perform the way it is supposed to perform, then we put it in the category of systematic risk, because the regulatory policy and responses are very different to how you deal with that risk, right? So conduct risk and systematic risk, and then if you just go around and thinking about it, the answers will become obvious. And again, in the broad sense of things, if your conduct risk is in relation of a person not knowing what needs to do, you need clearer frameworks, you need unambiguous definitions, you need training, you need public awareness. All of that good stuff is conduct risk when persons don't know. The second is the more vexing of the issue, conduct risk when the people knew what they wanted to do but nonetheless chose to do it. Their surveillance and enforcement is the only real way to stop that, right? I mean, you've done all the education, you've tried to do all the right things, that's not worked. Now you have to make an example of somebody who did something intentionally wrong with a view to discourage the next guy from trying it. And insider trading is a classic space of conduct risk in this category, where really there are no preemptive controls that you can put in place. You just make sure that you create such a strong example, and not just for the individual who's done it, but for the organization that allowed for that to happen, that controls then start evolving bottoms up into controlling that conduct risk. Then you come to systematic risk, and systematic risk of algos or high frequency systems not being designed adequately. Again, comes down to partly having strong frameworks in place that says exactly what needs to be done, strong pre-deployment controls along the lines of what we do in algo testing, so on and so forth. And then we come to, again, the more vexing part of the problem, which is what happens when a system, despite being designed to do what it does, has unintended consequences. And I think that's where we come into the question of systems will fail. By definition, no system is perfect, and you can never prove a system to be perfect. You can only show flaws. You can never show the absence of flaws. So you have to be prepared for the fact that systems will not do what they were intended to do for things that can't be foreseen. Night trading is a classic case in point. And that's where you need to have venue-level controls. You need to take this aspect of a contagion, something that brings the entire system down. That's too important to entrust to the participants to implement. That has to be brought in centrally. Exchanges need to manage that risk. Exchanges need to put in place circuit breakers, whatever we think is required to ensure that, notwithstanding everything that we have done, if something still goes wrong, we have a way to manage it and contain it. And I think, broadly speaking, if we look at our risks within that framework and each aspect of it, we will then be able to think about what our regulatory response should be to each of those. And I said, it's not just a black and white answer. Every jurisdiction will have a slightly different approach to solving for it. Thank you.
I think the answer is actually simpler than that. Look, we make markets in 26,000 securities, 260 futures, 27 currency pairs. We're a market maker in over 35 countries. We quote 750,000 options on 21 different exchanges. We're registered and regulated by the SEC, FINRA, CFTC, UK FCA, Hong Kong SFC. And the best performing markets for us, and trust me, given what I've just told you, we probably dabble in all of them, are the ones that don't interfere needlessly. I think that's the key point. So when you ask me which ones are you going to benefit from the most, it's the ones that don't interfere needlessly. And I think it's really that simple. And a lot of the things that you brought up, Nirav, about we need to have barriers, or systems are going to fail, and we need to be orderly, and we need to have circuit breakers. Again, having officially recognized market makers that are regulated provides all of that, because we're held to a higher standard, and we're held to a commitment that the market maker makes to the regulators, to the exchange, to market participants.
On this one, I think we'll probably have to disagree a bit. I think Ashish said the answer, and I don't necessarily subscribe to that answer, but that probably replies it the best, that just because locks on the door won't help doesn't mean we throw the locks away, right? I think we just need to figure out what's a better way to get the outcomes we want. Again, I think the focus need not be on control. The focus needs to be on what we want to achieve. And I think as long as we remain focused on that, the right regulatory responses will follow.
So all of us agree in terms of bifurcating the market participants, trying to understand what are they doing, what is their purpose of existence. For instance, need to bifurcate who's a market maker from a manipulative HFT algorithm, right? Now, when we talk about these things, the exchanges here have introduced something called as order-to-trade ratio, which is a very simplified way of differentiating market players, right? It's not a rocket science way. It's a very simplified mechanism wherein players of more than 100:1 order-to-trade ratio are penalized for having a higher order-to-trade ratio. Now, my question is, the economic disincentives which are currently in existence, whether a trading member is disallowed to trade in the next trading session for only 30 minutes, or is only penalized a fraction of a rupee for having a very high order-to-trade ratio. Is this good enough? And is an order-to-trade ratio a good enough mechanism to bifurcate market players?
I think you should go the other way around. I think market participants who have a high hit rate should probably get rewarded, don't you think? I think then people will actually, probably change the way that they trade, because they know that if they actually trade, then they'll get a reward. And just to clarify by what I mean by reward, we're talking the usual things, right? I mean, right now there's a The cost to transacting in India are very high, and there are lots of components to it. Everybody's subjected to it. And I'm just saying discount some of those for people who are willing to be transparent and open and create a fair market. I mean, there's no reason why, you should make it really expensive to transact. And then when you do it in a fair manner, you shouldn't get rewarded, especially if you're going to transact and you're not going to do it in a fair manner, you're penalized. So I don't know that penalizing everyone for everything is the right answer. Similar to, I like to talk about my kids. I've got 2 grown kids. They're taller and stronger than me. And, everybody can agree on what a bad parent is. Like, there are things you don't do as a parent, right? You don't, throw your kid into moving traffic or, bad things. The bad things are very easy, but deciding what the good things are, what to do. Do you let them drink the soda, or do you, let them eat the junk food? I mean, I don't know, is that good or bad, or do you give them timeout versus a spank? But if you start to reward good behavior, then people will police themselves. And if your order to hit ratio falls below a certain level, there's usually a good reason for it. And if there's transparency, then you can always ask the participant to explain why. But without the transparency, and if all you're doing is penalizing, people for not, getting fills on orders, I don't think you're going to solve much. I don't know, Narav?
So I think this whole discussion around the order to trade ratio has happened because of this worry around spoofing and the fact that there are firms who keep placing orders, and when you go and trade them, they're kind of vanishing out. So the question that we have to answer is, are we looking at solving that problem, or are we looking at solving a capacity problem with respect to the infrastructure of the exchanges, or are we just looking to put speed bumps in place? Because the fact is that if we are looking to answer a problem of spoofing, then the answer does not probably lie in putting a maximum order to trade ratio. The answer probably lies in identifying and in surveillance, saying that these are the algos or these are the numbers which are constantly being spoofed, and hence pull them up to his question of conduct, rather than penalize the entire market to saying that, these are a certain set of strategies which you cannot follow because they effectively raise your order to trade ratio above 100 or whatever. If you are looking to solve the problem of capacity, the solution to that is to enhance capacity and involve in that investment of capacity, rather than, again, laying a large policy framework saying that you cannot have a strategy which would require these kind of stuff. I'm a very strong believer in the fact that penalizing is not the only solution that can disincentivize participants from bad behavior, if that is what we're trying to look at. There are a whole bunch of policy initiatives which we need to start recognizing. I think it keeps going back to that same discussion, to recognize people for their good behavior and incentivizing them, rather than only looking at one end of the stick without really realizing what kind of a strategy is it which is requiring an order to trade ratio of 1:100. Having said that, globally there are exchanges who've incorporated this phenomena, but the results, the benefits of the whole thing continue to be elusive and unknown with respect to what they have achieved by putting in such disincentives.
I think I'll go to the question that Harjit presented, because you used the word bifurcate, right? Are we bifurcating the market between market makers and not market makers? I think all I'll say is there is no such sharp distinction. It's a continuum. There's a whole range of players in the market who are there for different reasons, who have different drivers, different ways of trading for good reasons. And I think it's a continuum along which we are trying to operate. Now, it helps to categorize these